Brian, let's talk about the sale of a primary residence. Let's say that I bought a home for $100,000 20 years ago and it is worth $1 million today. What sort of tax am I going to be liable for if and when I sell that home?
Yeah, I'm glad we had this because I get asked this all the time because most of my clients own a home, and at some point in their life they're going to sell that home, and they often mix up other tax rules around that. I heard X, and I'm like, no, that's not exactly the case. So some of the things I hear is, okay, I'm selling for $1 million. I'm going to buy a replacement house for $1 million, and I don't have to pay the tax, right? No. That rule went away with the Tax Reform Act of 1986. So all these years later, almost 40 years later, I keep hearing people say, that's still the rule, right? No, it's not. It doesn't matter if you buy another home. It doesn't matter. Well, I heard about your DSTs. Can I do a Section 1031 exchange? No. Section 1031 exchanges are only for investment real estate. Oh. Okay, so if I sell my house for $1 million, I paid $100,000 for it, am I going to have to pay tax on $900,000 gain? That depends. Have you lived in it at least 24 months out of the last 5 years? Yeah, I'm living in it now. I'm selling it now. I've lived there 20 years. Okay. That $900,000 gain, are you married? Yes, I'm married. Okay, that gain is, you can exclude $500,000 of that gain. So you will have, of your 900, 500 you don't pay tax on, but you will pay tax on 400. Oh, the next person might say, no, I'm not married. Okay, you get a $250,000 exclusion. Okay, so your gain will be the 900 minus 250,000. So the rest will be gain. Well, what if I buy another house and live in it for 2 years and it goes way up and I sell it? You get another 250,000. You can keep using this rule every 2 years if you want. You can keep moving from house to house so they go up in value. 250 to 500,000 can be excluded from gain. So there's a lot of nuances here depending on you're married, you're single, how long have you lived there. Some people, one of the things that they get caught on is they have a house that has a big gain. Let's say they're married and the gain is $500,000. And they think, well, I'm going to buy another house, but I'm going to keep our old house as a rental. Okay? So they keep the rental for 2 years, they rent it out, and then they sell it. Great. They can take their $500,000 exclusion on the gain. But let's say they rent it out for 3 years and a day. Well, now they haven't lived in it 2 of the last 5 years. It's no longer their principal residence. They've blown their exclusion for $500,000. So there is a lot of planning. I've seen this happen over and over. People think they're just going to buy up or they're going to turn it into rental and be fine. Think before you act. Think about what the taxation is on this. Finally, I will say, they'll say, how can I get out of paying the tax? And I say, well, you can die and get step-up basis. No one will ever pay any tax, but I don't usually recommend that as a tax planning opportunity.
Let's say that someone has a vacation home in another state. Let's say that they bought a home in Arizona. They go there during the winter months. They're snowbirds. They may spend 4 or 5 months there. How does this apply to that?
Well, I'm glad you brought that up because we've talked about investment real estate. I can do 1031 exchanges in active or passive real estate using DSTs. We've talked about your principal residence. We can get an exclusion on the gain of $250,000 or up to $500,000 if you're married. Now there's this one asset category right in between there. It's not an investment property and it's not your primary residence. It's the vacation home. That's probably got the worst tax attributes. I can't get an exclusion when I sell it from the gain, and I can't do a 1031 exchange if I use it personally because it's not considered an investment piece of real estate. So it's kind of in that tweener zone that really doesn't have a whole lot of tax advantages. You can plan to say, okay, I'm not going to live in it for a period of time. I am going to make it an investment property, and I'm going to do a 1031 exchange. Or, conversely, I'm going to move into it someday and make it my primary residence. But as it stands, your vacation home doesn't really get any tax benefits.
Brian, thanks for that great information. Very valuable.